Hey everyone, let's get started. Welcome to the October edition of the Cerini Nonprofit Connection. Obviously, life has been very, very interesting over the last almost half year or more than half year now. And COVID has completely changed the way that nonprofits operate, bringing with it a new set of risks. And that's part of what we're going to be talking about today. One of the key ways to deal with risk is through insurance. Today we have with us Stephen Fuoco, Senior Vice President of Bradley and Parker. He's going to discuss with us risk and how nonprofits can mitigate some of that risk. Welcome, Stephen. Thanks for joining us today.
You're welcome, Ken. Thanks so much for the invite. It's a pleasure to be able to address so many of our leading nonprofits. So thank you.
So before we get started, one of the things we always like to do is kind of get an understanding of how the person we're speaking to interacts and works with the nonprofit sector. So you want to talk a little bit about how you and Bradley and Parker work with the nonprofit sector?
Sure. Well, first off, nonprofits, in our opinion, are different than for-profits in so many ways, and I know that our audience knows that, but we know that as well. Meaning, they have different needs, they work in a different way, they have board of directors, which most for-profits don't have active board of directors, so we need to address that. Their mission is to help people more than it is to make a profit, obviously, by definition, and it's important we understand that and we react to that. And they have budgets that are different and fixed, and it's important that a professional understands that as well, and we do, as I know you do as well. And maybe another piece of it is we understand at Bradley and Parker that you need to give back to clients who are involved in the nonprofit community, and we do that quite often. And we support our nonprofits financially, as well as trying to give them the best risk management service that we can.
Awesome. So you touched a little bit on it, but when you think about the nonprofit sector, are there really significant differences between the risks experienced by nonprofits? So you talked a little bit how they're different, but how does that translate to risk in the nonprofit world versus the for-profit world?
In a lot of ways, they're the same, but there are definitely differences. And I did touch a little bit on the directors and officers. A for-profit company on Long Island that's not public doesn't have a real big directors and officers exposure. And however, all nonprofits have a very big directors and officers exposure, because those are the people who set the rules and the guidelines, or worse, don't set the rules and the guidelines that the operation needs to follow. So that's a significant difference between most nonprofits and most for-profits on Long Island. That being said, the public companies on Long Island or anywhere in New York City, they're quite similar because their board of directors have similar involvement and similar exposures and make the critical decisions. So that's one way. But the fact that nonprofits have budgets and programs, each program having a specific budget, that's an important feature of a nonprofit. And we as brokers and other brokers need to pay very close attention to that and understand how that impacts the executive director's decisions, the CFO's decisions, the HR's decisions, because budgets matter to nonprofits and funding matters to nonprofits more so than a for-profit. Plus, when you drill down, there are certain issues with nonprofits that are different, such as the sexual molestation exposures from their clients, possibly, and workers' comp issues. Also, auto fleets, as I think many of our audience might be aware of, especially during cyber. With auto fleets, do you transport your clients like you used to transport your clients? That's a big COVID exposure, and I know a lot of people have slowed down on that or cut it out completely, but that's not so much of an issue in the for-profit world. for most people. So those are some of the differences.
What about things like, and that brought up a whole bunch of different conversations, so I apologize. I'm going to hit you up with a bunch of different questions based on your
Go
response there.
ahead.
What about things like fundraising and remote fundraising, or use of volunteers, and what sort of exposure items come up because of those issues?
Oh, the volunteer question, I'm glad you brought that up actually, because that's one of the critical differences where obviously for-profit companies aren't going to use volunteers. And that is something very unique to our nonprofit world. I think, and what we've seen is that many nonprofits don't pay as close attention to their volunteer risk management as they do to their own employee risk management. And we should, because the volunteers can cause the same kind of harm or claims that a employee will cause. So perhaps closer risk management, better screening of those volunteers. But let's face it, that's difficult. I mean, you have a volunteer who's donating their time to an organization out of the goodness of their heart. How hard can you push on screening them and doing risk management? It's a balance. We recognize that, but to avoid it completely is a mistake.
Does that, if you do that risk management, such as background checks and stuff like that on your volunteers,
Mhm.
does that help you from a premium perspective, or it really doesn't come into play in terms of how the premiums or risk? Well, it clearly will help from a risk perspective, but from a premium perspective, how does it work?
Well, uh, thanks for that question, because you led me into something that I really wanted to cover, which is at Bradley and Parker, we have a philosophy that we try to make each one of our nonprofits best in class, meaning the very best, so that when we present you to an insurance company, we tell that insurance company through what's called an executive summary, all the work you've done to make your organization better than the next person, better than the next organization, I should say. And that example, Ken, that you just gave of screening volunteers is one of the things we would highlight in an executive summary, showing that you've put some work into your risk management that perhaps the next nonprofit never thought of. And what's really important there is to remember an underwriter who's sitting at a desk is no different than me or you or anybody watching this webinar today. An underwriter has to decide how good is this nonprofit? How much work have they done to make them safe? Because I can only give my best price to a handful of nonprofits. Is this the one I'm going to give my best price to? So screening volunteers is just one of those many things. Screening your own employees is another one. There's so many different things that can be done that we help our clients do. And by the way, I'm going to bet most of the people watching this say, I wear so many hats, I don't have time to do this. As much as I want to do this, I just don't have the time. And that's where having a good, trusted insurance broker who includes risk management is so important, because we are the people who should be doing 90% of this work for you. And so it shouldn't take your organization too much time to be best in class. It's our job.
Okay, so sorry, I'm going off on different tangents here, and I'm trying to remember all the questions that I have to still go back and ask you about. But I didn't realize that the insurance companies have some level of flexibility in terms of how they look at each organization to decide the fee structure. It's not just one size fits all.
Absolutely. So many people think it is one size fits all, and to some extent it is. It's both is the right answer, meaning every insurance company out there has a rate book that's been pre-approved by the state of New York or whatever state you're in. I think most of our listeners are New York, correct?
Mm-hmm.
So the New York State pre-approves rates for each and every insurance company, but also each underwriter has a set of credits or debits that they can apply to those rates. And those credits or debits depend upon how they view you or how you are presented by your risk manager or your insurance broker. And what we do at Bradley and Parker, and what we believe most brokers should do, is when we submit your information to an insurance company asking for the best price, is we'll include a 2 to 5 page executive summary showing the work you've done and why you deserve all the credits that they have in their pocket.
Okay. You mentioned earlier when you were talking about transportation and the need for nonprofits in certain areas to transport their consumers, which is different from the for-profit world. And you went on to say, you know, that bears with it the risk of maybe passing on COVID and things like that. Is that a risk that a nonprofit could get sued over if they're not taking proper precautions from a COVID perspective? And is there something that could be done from an insurance perspective to protect them? Because what I've heard is most insurance policies exclude the whole pandemic from, you know, what it is they're covering.
Well, it's a dangerous thing to have a consumer or a client, however it's referred to in each organization. It's dangerous to have them in the car with you because how can you social distance? Very difficult. But of course, wearing masks is good. Yes, an organization can be sued because you could be sued for anything. And what we're finding, and we found just yesterday in another Zoom call, is that a lot of these cases are being challenged. We haven't seen any claims yet be covered, but we're still in the infancy stage of this whole legal part of it. And it's my advice to everybody that's listening is just be extremely careful these days. Take as few chances as you can, but understanding that you have to take some chances.
Okay, so obviously COVID seems to be the thing that everybody is keyed in on. It's kind of, as I said earlier, changed the way we all do business and everything else. What new exposures have you seen kind of pop up because of the COVID pandemic that maybe didn't exist before the pandemic, and maybe it's not on everybody's radar that they should be thinking about, you know, because a lot of people go on autopilot when it comes to insurance?
Great. Well, probably the biggest one is the cyber liability exposure that didn't exist to the extent that it exists now. And what I mean by that is so many people are on Zoom like we are today and on Teams and different video conferences, but they're using computers that perhaps are unusually are at their house or at a different office. So the cyber exposure is significantly worse or more than it was previous to March when everybody was working in their office. So that's the biggest one. And what we do,
we've definitely seen a big uptick in the number of phishing emails that are out there. It's amazing how creative they have gotten with some of these phishing emails, such as they'll send something and they'll put on it pretty big, you know, if you no longer want to receive these emails, click here. And they're using that as a way of gathering your information, getting into your computer. So they're getting a lot more creative in terms of how they're using phishing schemes.
Yeah. One thing that we're finding a lot in the for-profit world that so far we haven't seen much in the nonprofit, and I sure hope it doesn't happen, is ransomware claims that are happening under cyber, where, for anybody who's not aware, that's where somebody locks up your own computer system and asks you for money, usually in the form of Bitcoin. And until they get that money, they keep your computer system locked up, and it become a terrible thing in the for-profit world. And I just hope they don't.
It's happening in the nonprofit world too.
Yeah, I haven't seen it, thank goodness, with any of our clients, but you have seen it.
Not with our clients, but I've been talking to cybersecurity experts, and they said that it's definitely on the rise.
So Also, what's really important for everybody to understand is that ransomware claims 2 years ago weren't as prevalent, but they also weren't as big. They were maybe 10,000, 15,000, what you might call a nuisance, more of a financial harm. Now we're seeing most ransomware claims are more like 100,000, 500,000. I mean, they have jumped like crazy, and to a point where this is impacting everybody much more considerably than it ever did before.
And these are all insurable things that people can look at from an insurance perspective?
Yes, and I especially want to talk about the risk management side of that, if I may.
Go ahead.
Um, Sometimes the best answer isn't just insurance, but the best answer is to do the work to prevent the thing from ever happening, or do everything that you can to prevent it. Because even when you have insurance, it's still a very stressful situation to have your computer system locked in ransomware situation, to have it locked up for a day or a week or a month. I mean, this is something you want to avoid. So we are big proponents of risk management, and like two tools that should be commonly used is a cybersecurity assessment, which we can help with, and then also making sure that you have a qualified cyber person that you deal with on the outside, a cyber professional, and we work in tandem with them to try to eliminate the risk. But in addition, we can sell insurance. And by the way, cyber insurance is still very affordable. Like average price of maybe $5,000 a year, you can buy a pretty robust policy to protect the agency, God forbid.
One of the things that that we've been talking to our clients about is training and making sure that they're appropriately training their staff with respect to these risks and the phishing schemes and everything else, especially with people working more remotely. Also ensuring that, if they're sharing a computer with their children, you got to be very, very careful, because kids might click on things that adults know better not to click on, and that if you're using that same computer to log into work, it could be opening up a whole new level of exposure there. So there's a lot of different exposure items that come into play, and we've actually retained a company that's been sending us phishing schemes to see how many of our staff they can catch to click on these things. And again, they're pretty creative in what they've been able to put together to. And I guess this goes back to that cover letter that you're talking about. If you were underwriting us or looking to put us out there, you talk about all these different things that we're doing that can help to mitigate the level of risk from a cybersecurity perspective. And those are the things you're talking about that nonprofits should be doing too, right?
Absolutely correct. And you made me think of one other point I do want to make about the cyber, is that if you apply for cyber insurance, cyber protection, one benefit of just applying, even if you don't buy it, is that the underwriting process will reveal the weaknesses in your company, similar to what you just explained, Ken. Like that phishing test and stuff, they have ways of identifying where your system is weak, so that even if you don't buy the insurance, you now know where your weaknesses are, and hopefully you can strengthen those weaknesses.
What about for employees changing subject a little, what about for employees that are now working from home? What additional exposure do you have if an employee is working from home with respect to things like workers' compensation? I'm home, I'm working, I go to the bathroom, I trip over the rug in my hallway, and I now can't work because I broke my arm. I mean, is that a real thing? If it is a real thing, what sort of coverage or exposure, or what can I do?
Yes, it's a real thing. Yes, it's a new exposure or growing exposure, because I shouldn't say brand new, because a lot of people have been working from home for a long time, but now obviously it's grown dramatically. You need to be safe. I do recommend an education process, to use your words, a training process, where you try to set up with each employee, maybe on a Zoom meeting, telling them all how to be safe and to follow certain protocols. One of the things we recommend where possible is that everybody have private offices at home as much as possible. So to try to work from a private office as opposed to in a public space, like your kitchen, et cetera. But we recognize sometimes that's extremely difficult. But a private office will be safer than a public space. So that's important. And
Can you set up workplace protocols and safety policies for people to kind of implement at home? Do you have that ability to do things like that?
we do, and we do have guidelines with that we've developed since March and since the COVID problem happened. And we'd be happy to share those with anybody who might want some. And so we can send that to you and you can send it out if you'd like.
That'd be great if we can share that information.
Yeah.
So continuing along that line, I mean, nonprofits obviously have been experiencing changes in their fundraising, where they used to do a lot more events, and the events all had their own risk, where you had to worry about insuring the event and insuring the location and all that other stuff. Now they're doing things more virtual. Are there additional exposures or concerns that come up through a virtual event, or a cancellation of an event, or any of those types of things that nonprofits need to be worried about from a risk and from a insurable perspective?
Well, yes. And I'll take one example that one of our nonprofits is holding an event, and it's a virtual event to an extent, but it's also a live event. And I think that that's happening more frequently. And what I mean by that is, so you may be able to follow it on a screen like we're doing right now, but for instance, you might be buying dinner where it used to be a gala where everybody would gather in one place. Now you might be able to pick up your dinner at a restaurant someplace in your area while other people are picking it up in a different town. But that involves different restaurants, perhaps, for the same virtual event. I think what's being missed is, do those restaurants have insurance? Do those restaurants have product liability insurance? Are you checking those things? So this is requiring a little bit more risk management and persistence on the part of our clients than it did before.
So you're saying that if I direct you to a restaurant in your neighborhood, like recently there was an event where it was a chili event, and they were sending people to 3 or 4 different restaurants to pick up chili. Right. So those types of things.
Exactly right. And so is the restaurant in Sable, for argument's sake, are they insured? And you do need to check that, because to use your example, if the chili was bad and all of your donors
there's some bad chili out there. Oh, that's not what you meant. Okay, sorry.
Right. If it's sickly, I should say.
Okay.
Right. And so, yeah, there's new exposures being developed as a result of this. And one other that I wanted to bring up, which is unfortunate, is a lot of agencies and organizations, nonprofit and for-profit, have had to lay off people as a result of COVID. And that brings up the whole termination exposure and the employment practices liability. So you do want to check that policy and make sure you have it, of course, and make sure that it's set up properly, and that's important.
So I'm going to jump back to the cybersecurity component in a second that we were talking about a few minutes ago. So if I am doing a virtual fundraising event, okay, and I've got people kind of tapping into my virtual fundraising event through some sort of platform, whether it be Zoom or something else, what exposure, or am I creating any exposure for the nonprofit organization, because I now have all of these people kind of hopping into a platform and maybe opening up their computers and stuff like that I know there's, in the past, Zoom had a whole bunch of issues with people hacking into it and everything else. What
Sure.
happens if something like that happens through one of these fundraising events or,
Well, it's definitely an increased exposure than it was before. Usually those same events involve donations, and those donations are made online, sometimes during the virtual event or sometimes before or after. So you have the possibility of people's private information being hacked. And
Mhm.
will the nonprofit be held at all responsible for that? So again, that's a good reason to have cyber insurance and to protect against those type of claims. Thank God we haven't seen that, but can happen.
Yeah, and again, I think that's a lot of the phishing stuff that takes place. People get into a system and they just sit there and wait for the right opportunity. So they could be sitting there for 6 months, a year, and then you do a big fundraising event with a bunch of different people, and they can kind of send out email blasts to all these people from you, basically making it look like it's part of the fundraising thing, and boom, they
Yep.
found their opportunity. So, got to be careful. Um, all right, we've been talking about risks, but now let's talk about cost, because insurance is a pretty costly thing in certain respects. And again, there's a cost benefit ratio that goes in here, and you have to analyze and determine, what's the best way to go. But what are some of the things that, the nonprofit sector, who has definitely been hit hard in terms of fundraising and hit hard in terms of, bringing in, dollars into the organizations, what can they do to maybe proactively help lower their cost of insurance?
I want to give you some exact ideas, and I will. But before doing that, if it's okay, for 5 minutes or so, I'd just like to talk about the big picture regarding costs.
Go for it.
And then I'll give some specific examples that everybody can use and that should help. But going back to what we said before, Ken, is that you want to be best in class to control your costs. That's the biggest thing. Like, there are some other specific, let's call it micro benefits or micro tools that you can do. But on the macro level, you want to be best in class. That's going to give you the biggest advantage. That's the first step. And I want to talk about how to do that.
Okay.
Um, I, I tell a story sometimes to people that um, when they just tell me, people wake up to their costs usually 30 days before the policy is about to renew, sometimes 60 days. They say, my policy is renewing. I hope it's not going up. I hope it's going down. And of course, that's natural. But my response to that is, uh, it's like visiting the dentist, where if you walk into your dentist 30 days before your meeting and you say, I'm going to start brushing now because I don't want any cavities and I don't want any root canals, so I'm going to start brushing now. The answer is, you should have been brushing all year if you want no cavities and you want no root canals. And insurance is just like that, meaning my biggest advice to everybody is, do risk management as part of your organization all year long. We do. That's part of what makes us different at Bradley and Parker. And some of the examples that I want to talk about, just as a 30,000-foot view, is there's a 4-step process of risk management that everybody should be following. First, identifying what their exposures are. Second is strategizing how you can get rid of those exposures. Third, implementing the strategies that you came up with. And then fourth, monitoring it on a regular basis, month to month to month. If you're not doing that, it's hard to expect to really control the cost of your insurance, because your underwriter expects you to do that if you want their best price. So it's
Okay.
important that you understand that, and a good broker will provide those risk management services. So that's part of the executive summary that we talked about. And here are some of the specific tools that I wanted to talk about. The first thing is, make sure you're reviewing your claim reserves on a regular basis with your broker. Regular basis being at least twice a year. So everybody has claims, and every claim has a reserve set on it if it's still an open claim. the higher that reserve is, the more you're going to pay for your insurance. So if you're not reviewing them on a semi-annual basis, at least, you're probably going to pay more than you want to. So that's step one. Another thing is, do you have a safety committee in force that meets on a regular basis, such as quarterly? And the safety committee should be all the important people in your organization where you talk about safety and how you can be better. So that's certain.
And I assume if you're going to be talking about it, then as you said earlier, it's also how did you go about and implement it, and can you prove you put that into place?
Yes. And do you have minutes of those safety meetings that we can include in our executive summary, where we can show the underwriter, you've done these things, or at least you've tried. You've identified the problems, you've made an effort to fix it, and that matters. But other specific easy things, ask your broker and ask your insurance company, are there any available credits that I'm currently not receiving on my policy? And can I get them? So it's a simple thing. Ken, you mentioned earlier, are the rates all the same, or, whatever. And I mentioned that underwriters have credits in their pockets. If you don't ask for them, you probably won't get them. So ask, and believe me, it doesn't happen all the time. And one maybe perhaps last item I'd like to talk about is shopping your insurance. How often should you do it? What's the most effective way? And this, of course, is very important. We usually recommend to our clients, let's market your insurance every 3 to 5 years or sooner if there's a sizable increase in your premium. But as long as there's not a sizable increase in your premium, every 3 to 5 years is probably prudent, especially if the broker you deal with represents the best markets in the country, which I'm proud to say we do. So, but every 3 to 5 years is good. More frequent than that can have actually negative effects, because insurance companies do keep track of, how often you are out to market, and it's sometimes considered a negative thing.
Okay, I'm going to continue down that line in a second, but we did have a question from the audience. Somebody was questioning whether there are different types of cyber insurance, or is it one size fits all scenario? So like things like phishing, ransomware, social engineering, transfer fraud, any of those types of things. Is it a single policy that covers all those things? Is it you pick and choose? How's all that work?
Great question. It's one policy usually, but the policies allow you to pick and choose the coverages that you want. So it's usually 5 different categories or 10 different categories, and you could pick the ones that are most suitable for you, and you can exclude the ones you don't want. So it's very customizable.
Okay. Getting back to the pricing sort of things that we were just talking about, I've heard that there have been several of the larger insurance carriers that have kind of gotten out of the nonprofit space. Is this true? And what does that mean for the nonprofit sector?
It's true to a certain extent so far, and it may become more true in the near future. Another story I like to say to make sure people understand this is, as that does happen, and it is starting to happen a little bit, it's almost like a game of musical chairs that maybe we all used to play when we were kids. So
we still play.
Yeah, okay. And so everybody can relate to the game of musical chairs, most likely. Meaning, if you lose your chair, or if your insurance company comes out of the game, you're now walking around the table looking for a new insurance company. But guess what? So is 1 or 2 other people. So now it becomes even more important to be best in class, because you're now trying to convince fewer insurers that you're the best, and so is somebody else. So, because basically there are about 5 really good insurance companies out there that love nonprofits and are really good at them. Then there's about 100 others who aren't. So you want to be with one of those 5 that are really, really good, and being best in class will help you get there. So yes, the insurers are dropping out little by little. It's becoming a smaller game. I don't see that changing.
Okay. You talked about earlier when you were kind of explaining the difference between nonprofits and for-profits. One of the first things you talked about was that nonprofit organizations have boards of directors. Okay, which means then there's the need for D&O coverage, directors and officers liability coverage, and that becomes more vital in the nonprofit world than it is in the non-public for-profit world. There are exposures, obviously, within these policies that boards may not be aware of. What are some of the traps that you've seen, or some of the issues you've seen in some of these D&O policies that have left nonprofits like kind of scratching their head saying, damn, I thought we were covered for that?
Well, first off, to make sure everybody understands that the D&O coverage is basically to protect the directors and officers for bad decisions that they made, or for decisions that they did not make that they should have made. And the reason I start with that is because it's probably a good idea for each one of the listeners on this call to assess their directors and officers' procedures to make sure that you're doing everything you can to make sure you're best in class regards to how you treat your directors and officers. And there are tools that you can do easy assessments to, basically 10, 15, 20 questions that each agency can ask themselves, procedures, policies. Are you being careful with your directors and officers? Are you best in class? So
do you have a list of what those questions are that we could share with the group?
We do, and we'll get that to you.
Thank you.
So, and that's a really good first place to start, to make sure that you're following the best practices for directors and officers. And guess what? If you do, it probably will take care of itself, because that will lead you to perhaps adding certain coverages to your directors and officers policy that maybe you don't have now because it wasn't thought about. And one thing that's really, really important is for everybody to understand, for the most part, especially with the larger nonprofits, directors and officers insurance is such a small part of your insurance budget, less than 5%. I know that's not so true for the smaller nonprofits. The smaller nonprofits will see it as a bigger percentage. But what the message I'd like to say is, this is not an area to skimp, because hurting your directors and officers could really hurt your organization. So don't skimp in this area. Spend the time to assess your weaknesses and spend the time to improve on them, and perhaps broaden your policy to take out the weaknesses that there might be in there. That's the most important thing. And
I mean, there's also, compliance related or governance related issues that are big there too. I mean, it's simple things like making sure that you're complying with your mission and your certificate of incorporation. It's, are you complying with the bylaws that have been established, so that, if something goes wrong, the insurance company can't point at the bylaws and say you weren't even following your own bylaws, therefore we're not covering you because you set parameters and you weren't even following them. So it's really just making sure that, even as simple things as, if there are policies or there are practices that are established within the organization, that those practices and policies are followed.
Yeah. So to your point, follow your mission statement, stay within your boundaries of why you were created, and try not to get out of it too often, if ever. But going back to the risk management recommendation is assess your practices for directors and officers. And guess what? That it doesn't happen a lot. Most organizations don't take the time to do that, and we do recommend it.
I think most organizations, unfortunately, don't take the time to really review their insurance on a regular basis in terms of really understanding what their exposures are. And I think it really makes a lot of sense for organizations to sit down on a regular basis with their insurance broker or risk manager or whatever, just to really gain a true understanding of what risk they're accepting versus what risk they're insuring.
Yeah,
Um, do
agreed.
you see that happening more or at all, or what?
No, I do see that, and I'd absolutely see that. Ken, I also wanted to mention one thing about directors and officers that I think is important. And some of our listeners probably already know this, but for those who may not, a directors and officers policy can be just directors and officers insurance. And in many cases, it is. But it can also be amended to include your employment practices insurance. And it can also be amended, broadened to include fiduciary liability. And sometimes that's a really good idea to expand the directors and officers policy to include those two areas. Many people have them separate. Some people forget about fiduciary liability completely. To answer your first question, that's an area that, that's uh, for argument's sake. Uh, I hope, obviously, this has never happened because it shouldn't have anyway, is that a nonprofit invests all of their retirement funds with the Bernie Madoff retirement plan. And all the money is gone the next day. So that would be a fiduciary liability. You want to make sure you have fiduciary liability insurance either separately or as part of your directors and officers coverage. God forbid something like that should happen.
Steve, we're kind of running low on time, so a couple of really quick things. What do you see as some of the key takeaways that you want to make sure people get out of today's discussion?
I really hope that everybody steps up the risk management side of their insurance program and gets away from just expecting rates to stay level and expecting to get the best rate without doing the work. Because that's a bad road. It's the insurance market is hardening today for the first time that I've seen since I've been in the business. The last really hard market that happened was 1988. And since then, the market has been soft and things have been great without putting too much effort into it. You could renew your insurance at a reasonable cost. Absent two spikes since 1988, which was 9/11, that was a difference. For about a year or two, insurance went up, but then it came back down. And then in the banking crisis, in 2008, 2009, same thing happened. Prices went up, but then they came back down. Well, I think regretfully, the soft party is over and that risk management will really pay now. So I'm encouraging everybody, whether they do it through us or anyone, to please pay more attention to risk management. Do the 4-step process of assessing your risks and taking the time to try to strengthen all your weaknesses, so that you become best in class, and that will protect the cost you pay the best.
So that also includes reviewing your loss experience runs, understanding why you're getting losses, and then incorporating that into your plan for improvement.
Absolutely. Reviewing your claims for the past 5 years, maybe 6, 7 years, is a critical process. Good point.
Okay. Really quick, if somebody wanted to reach out to you and ask you more questions or go over something with you, how could they get in touch with you?
The best way is through email, and or calling my cell phone or
So why don't
texting
you
me.
if you want to give that out, go for it.
Sure. Email is sfuoco, Fuoco, at bradley-parker.com. And my cell phone that people can call almost anytime is 631-786-8412.
Awesome. Nice job, Steve. Really appreciate your time educating the sector today. This was great. I think it really provided a lot of great insight into what nonprofits need to consider from an insurance perspective. So I thank you very much.
Thanks, Ken.
Hopefully everybody enjoyed this. Tune in on November 10th at noon when our guests will be Erin Ward and Bobby Erlert from Inspire Hearts Fundraising. We know that you guys are getting into your year-end capital campaigns and year-end fundraising campaigns. So we want to give you some insight into what that should look like under this new world order that we live in. Also, don't forget that we have a little over a month left before applications are due in for the Long Island Imagine Awards. So if you haven't gotten your applications in, please get them in. They're due by November 30th. Stay safe. Thanks, everyone, and we'll see you next month. Take care.